Welcome to FreightWaves Today. I'm Craig Fuller. Here, Julie, another great Monday. We've got a great show today. We're going to talk about finance, a big conversation around truck finance. You know, with the market recovering, there's a lot of desire for new trucks, and we've got Daimler's Chief Revenue Officer, Daimler Finance, to talk to us about what they're seeing. Daimler is obviously the largest truck OEM in the world, and their finance business will give us perspective on what exactly is happening in the market.
Yeah, I'm excited about that. We've got a lot of good guests today. We could talk about the market in general, right? So truck financing and what's happening, and then some good conversations around what maybe to expect as earnings are coming out, or what we'll be watching. And we get to talk about Orderful today as well. So,
and we also have the chief economist at Piedmont Crescent Capital to talk about the economy, what's happening in the economy. We have Chris Versace. He's the chief investment officer and thematic strategist at Thematica Research, is going to talk about logistics stocks and earnings season. This is earnings week. It's the point of my Sonar version or Sonar update is all about the J.B. Hunt's earnings, because that's the outlook we have for. They're the first one to go. They're always
Wednesday, right?
The first one to report, and so we get a real sense for how the market is performing. But I always look forward to J.B. Hunt's earnings because they really set the tone for the entire sector, but they also give us a sense for what they're seeing and likely to see. They have one of the best business models in the entire space. So their diversity of business, really their intermodal operations, as well as their dedicated operations, I think give us a huge perspective on the overall freight market.
Yeah, you know I love talking about dedicated. So
yeah, dedicated is one of your favorites. You ran a dedicated operation. How many trucks did you guys have when you were running it?
About 3,000.
About 3,000? It's a huge dedicated operation. So I always told my father that he should have split up the company between dedicated, over the road, the team operations, and just get rid of the OTR solo business, which is always sort of the drag on the overall business.
Always the hardest part to make profitable.
He didn't ask me for my opinion. I gave it unsolicitedly. Otherwise, maybe they would have done something. Who knows? Yeah,
but it's going to be a great week. We will be live from Chicago on Wednesday as well, from the AI symposium there. So we'll be doing the show live. It'll be great. And gosh, we'll have to talk about the Strait of Hormuz too today.
Yeah, there's some action in the Middle East. I don't know that thing's going to get resolved anytime soon.
It's not looking that way.
So speaking of, let's get into the headlines.
We kick things off with a major escalation in the Middle East that's sending shockwaves through global energy markets and ocean shipping. Iran on Saturday attacked a feeder container ship transiting the Strait of Hormuz, setting the 7,000 TEU GFS Galaxy ablaze and forcing the crew to abandon ship. The vessel, owned by a company out of the United Arab Emirates, was exiting the strait on a service calling Jebel Ali, Dammam in Saudi Arabia, Bahrain, Port Klang in Malaysia, and several Chinese and South Korean ports. Iran over the weekend declared the strait closed to vessel traffic and expanded missile and drone attacks on Bahrain, Kuwait, Qatar, the UAE, and Jordan. The flaring hostilities have pushed Brent crude futures up about 12% since Friday. European natural gas jumped nearly 70%, and U.S. gasoline futures rose roughly 10% since late last week. The crisis also shadows Maersk's announced plans to restart scheduled services through the Suez Canal and Red Sea, raising fresh questions about global shipping route security. Over in the automotive sector, Toyota is making a massive bet on Texas manufacturing with a stunning $3.6 billion expansion in San Antonio. The Japanese automaker is shifting production of its popular Tacoma pickup from Baja California, Mexico, to San Antonio as part of an investment that will double the size of its Texas manufacturing campus and create 2,000 new jobs. The expansion will add a second vehicle assembly line at Toyota, Texas, allowing Tacoma production to join the Tundra and Sequoia at the automaker's San Antonio complex. The company said the transition from Toyota Motor Manufacturing, Baja California, will occur gradually over approximately 4 years, with the expanded facility expected to be fully built out by 2030. The expansion adds around 2.5 million square feet to the San Antonio campus, bringing Toyota's total investment in the facility to $8.3 billion since construction began in 2003, and the completed plant will employ approximately 6,000 workers. Finally, Wall Street is raising the bar for trucking carriers heading into second quarter earnings season. Deutsche Bank analyst Risha Harnain is forecasting mainly beats across her transportation coverage, with less than truckload carriers leading the charge. She expects median earnings per share growth of 15% year over year for the second quarter and 21% for the third quarter, marking a meaningful improvement from the 3% increase the group recorded in the first quarter. Harnain raised numbers for both the truckload and LTL carriers she follows, with her LTL forecasts increasing roughly 8% on average and sitting above consensus expectations. Less than truckload demand is starting to reflect 6 consecutive months of positive manufacturing data, with intra-quarter updates from public carriers showing tonnage turned positive for the group in May following an extended downturn. The second quarter earnings season begins on Wednesday, when J.B. Hunt reports results after the market closes.
So, Julie, this is earnings week, big time. LTL getting an upgrade. I think some of that's fuel related. Fuel surcharge is a big piece of the LTL business. We've seen some recovery. You know, if you really want to understand sort of the state of the LTL business, Cass's shipment index has more concentration in LTL than it has in truckload. This is oftentimes missed by investors. I don't know that they understand the mix that goes into that index, but we know it here, where the Cass index has more. And what we've seen over the last couple of months is we've seen a really for the last year, but certainly the last 6 months, has been a slowing of the Cass shipment index, number of freight bills handled. That is just because shippers are starting to consolidate into truckloads. And you see that in the recovery, and I think that's why the LTL company is going to do quite well.
Yeah, well, it's also why it's good to have not just the Cass shipment index, which is incredibly valuable, but sonar data as well to see the context and the bigger picture of what's happening. But yeah, interesting headlines. We talked about the Strait of Hormuz. Is that ever? Yes, eventually it will resolve, I'm sure.
Does
but
it though?
It feels like it is every time a step forward, 2 steps back.
I mean, look, the Middle East has been in the war for, it's a very warring part of the world. It's a very tribal part of the world in terms of these tribal, and you're messing so many different cultures together. I don't know that it gets resolved in terms of not having flare-ups. I mean, we've been effectively in war with Iran since the 1970s.
Fair.
And so there's been so much of this that's continued to happen. My view of it is it's probably more of a permanent. I don't know that we're going to resolve it anytime soon. And so I think what's ultimately going to happen is that, as we had our guest from the UAE on last week, Saudi Arabia, I think countries and businesses are going to start routing around it is what we're going to see.
Well, yeah, I mean, that was mentioned in the Morning Minute as well, right? That Maersk is now using the Red Sea and the Suez Canal and looking for alternates. So we'll see what happens there with other geopolitical stuff.
Yeah, but a lot of it's energy related, which, when you're doing containers, that's one thing, but you got energy that, especially the countries that are sort of upstream to right at that choke point that's in the Hormuz. That's going to be the challenge. But, UAE's got a solution. Saudi Arabia's got their pipeline. And so I think it's just going to be a cost of doing business going forward. The nice part about this is, as we get further and further distance away from the sort of start of that conflict, companies have already made contingency plans. They're moving. We're seeing the United States, you could argue, is a beneficiary for U.S. oil and natural gas, has benefited from the disruption, particularly for Asia. Japan's done some pretty aggressive deals where they're going to be sourcing natural gas and oil from the United States. So, those things are super positive.
But do you think this will be a short-term sort of pop we see in Brent crude prices?
Yeah, I mean, we've seen
diesel
it. I mean,
prices?
you said 12%.
The
I think was the
futures
number.
were up, yeah. So.
Futures are up, but look, we're still. I think WTI this morning, again, I haven't looked at it in the last hour, was $74 a barrel. If you go to where we were, $115 a barrel back in April, or maybe March, there was some maximum stress that's gone. And providing some relief. And look, even diesel prices, while they're still elevated from where they were in January, we've come down quite a bit. Now it's flattened. That's retail diesel that's on your screen, but it's come down almost half of what it was, the increase that we saw. So it's flattened. We're probably going to see it probably stay there. It looks like the truck stops are being able to hold price. Demand helps that. Because ultimately, what they're worried about is losing volume and gallons. We heard last week, I think it was from Pilot, talked about the fact that they don't make a lot of money on retail diesel. They make a lot of money in the C-store, and that's really where they're concerned. So all these things are super interesting, so much to talk about. Let's get into the truck finance conversation. There's no better person to talk about this than the Chief Revenue Officer of the largest lender in trucking, Daimler Truck Financial Services, Tobias Waldeck. Tobias, how are you today, sir?
Very good, Craig. How are you?
Doing fantastic. First, before we start, my father, Max, wanted to thank you for all the work that you did during his career. Daimler financed it. He credits Daimler with helping U.S. Express grow to be one of the largest truckload carriers. And he called me this morning. He was so excited to see that you were on the show. So he sends his regards to you and really says, look, this is his message. Again, an unpaid solicitation from my father or unpaid endorsement. But he said, look, they were an amazing partner throughout the years. He credits Daimler Truck Financial Services with really helping build U.S. Express. So that's his endorsement. Again, I'm not paid to say that, nor is he, but I think he's indebted to what Daimler Truck Finance did for him during his, when U.S. Express was a part of the family enterprise.
That's very nice. And tell him I said hello, please. I hope he's doing well.
I will pass it on. You know, this is a really interesting market. I got to get your take over the last couple of years. You guys are, obviously when people are buying new trucks, most of these transactions are financed. It's been a difficult time. How has the overall financing market been for the last couple of years?
Well, and I mean, this is something that is very painful to all of us, right, Julie and Craig? For 4 straight years, I just looked up the data this morning. For 4 straight years, we've lost capacity from the market, and it's been the longest freight recession on record, right? And so it's been a slug for all of us. But on the other hand, on the more positive side, I think we've seen the worst of it by now. So we after 4 straight years really started in Q2 in 2022, and Q2 26, hopefully, fingers crossed, marks the exit from the longest freight recession on record, and it shows on our books and it shows on our customers' books.
So when do you think we came out of the freight recession? Like, when would you declare it over with? In terms of, was this a November thing, as we've argued, of last year? But when did you guys see it in terms of activity?
It's, you almost don't want to jinx it, right? It's been, we've had several false starts in 25, but I remember in March of this year we were at the TCA convention, and then I mean, we had several guest speakers, and Chief Bars was there, and I don't think I've ever heard a government official get a standing ovation when he talked about enforcement and taking unregulated capacity out of the market. And it was almost palpable in the moment in the room that people felt it's really over now. So yeah. If I had to pin it down, I think it would be that moment.
Well, I have a ton of respect. We've had Derek in the studio, Administrator Bars, in studio, talk to them. It's interesting because, to your point, if you look at the Louisville Truck Show, which, it's one thing to have the executives that are part of the TCA that are really interested in the economics of this industry, but it was another to see truck drivers, the ones that are certainly most, the people that sort of on the front lines that feel the regulations, to treat both Sean Duffy and Derek Bars as rock stars, I thought was a really interesting development, because here's the chief regulator that's, the police of the industry, if you will, that is treating like a rock star. It just shows how much pressure and tension exists in this business.
Yes, I would agree with that, Craig.
So I want to bring Kevin Bangston in. He is the CEO of Daimler Truck Finance. Kevin, when we think about how you guys have positioned your business in terms of the downturn, what did you guys do to really insulate yourself from exposure in the market? We don't have audio for unfortunately, we don't have audio. So Tobias, let's talk a little bit about the overall, what you guys are are sort of experiencing right now. How are fleets thinking about their investments this year? Are they more bullish? Are you seeing them ramp up truck orders? And is that how are they thinking about the way the business is operating?
So as we said, Greg, right? I mean, our customers have been through a lot, and so they're not bullish. I wouldn't call it bullish. But on the other hand, if we look at the three main segments that we serve, being one being dry van, the other being refrigerated, and the third flatbed, right? And so over all three segments, I see we call it cautious optimism. So what really and going back to Chief Bars and the government and the regulation, really what happened is we've taken a lot of these, and I don't want to be saying something out of turn, but some of these operators that maybe weren't completely compliant, we've taken that out, and so. I would say most of our customers are very compliant, and so it's given them now finally a level playing field, and that's enabled them. They've used their equipment a lot over the last 4 years in the freight recession, and the investments we're seeing right now from our customers is mainly replacement. They're basically now coming back to a normal truck replacement cycle. A little growth here and there. I see some of that in the flatbed. Flatbed is really extraordinary right now. We see a lot of things driven by the AI data center construction. So flatbed is kind of a separate story, but other than that, we see our fleets, ordering trucks and going back to normal replacement cycles, which they've put on hold and extended over the freight recession.
Yeah, for sure. Flatbed has been absolutely insane, just how it's been ripping at record all-time highs. We see it in tender rejection rates above 50%. That's cooled off a bit. I think some of it was earlier this year, Julie. We got a lot of volume to position for that big summer building season. It's cooled off a little bit. But what's interesting about flatbed is it's usually driven by the housing market. Housing market has been sitting this round out, but it hasn't hurt the flatbed business at all.
No, we say cooling off from 50% tender rejection to 25% tender rejection, which is still massive. So.
Yeah, absolutely. But it does tell us a lot about what we're doing. We have a great research report we did on AI data centers. I was shocked to learn that a 500 megawatt data center, which is no longer the biggest kinds of data center, a couple of years ago, that was a huge data center. Now we've got something like we're now the 10 gigawatt, which is absolutely massive. But the 500 megawatt data center is 30,000 truckloads, which I think 60% of that, 70% of that is flatbed. I mean, it's just absolutely astounding the kinds of infrastructure build that's driving this market. And I'm glad to know that you guys are seeing that as well.
So I want to shift gears a bit. I'm going to try to bring it back in, Kevin. And if the audio is not working, then Tobias, please.
Hey, Kevin, how are you today?
Yeah, feel free to jump in.
Hey, good. Sorry about
good. No, it's great. Welcome.
So,
we've talked a bit about, you guys also have talked about Daimler Truck Financial Services shifting from just a captive finance company into a full service partner. Can you describe to us a little bit about what that means, what you are incorporating, and what it means for your partners?
I mean, I think it spans a variety of topics, right? But I think, first and foremost, I'd point to kind of the link points that we're providing for our customers across the, let's say, Daimler Truck North American ecosystem, right? So in that regard, a lot of what we're looking to do is kind of connect the sales experience through the financing experience, through the aftermarket experience, and bringing in bundled solutions around things like insurance offerings, around things like extended warranty offerings, and so on. And so we do that very much in concert, I would say, with Daimler Trucks North America, as I mentioned, and with my colleagues on the operating committee there, who run sales and after sales respectively. And I think that gives us kind of unique position, to really look for what's best for the customers and provide the solutions they're looking for in a way that goes well beyond what we've done historically.
So let's talk a little bit about EPA regulations have been on the mind of this, NOx regulation. Sort of delayed. I think we were a couple of months delayed. Maybe you guys could argue you wish you had more time than just even a couple week delay. But we did get delayed. We finally have some guidance, some potential. I mean, we have the final rule that's been released, but I think it's 45-day of implementation. What does that mean for the industry? Are you guys seeing fleets pre-buy, or are they sort of sitting this one out?
I mean, I wouldn't say we're seeing a dramatic pre-buy of any sort, Craig, but I do think we're seeing increased order activity, right? And I think you well know that last week, the EPA did give some of a reveal on kind of where we're heading here, and we think that they're doing a really nice job, at least, of listening to the various, let's say, players in the industry and marketplace, ourselves included. And from that perspective, I think, continuing to kind of look for affordability for those companies that operate and drive trucks, right, our customers, but also improving emission standards. I think that's the balance they're trying to strike. And as I said, we're happy that they've been receptive to hearing from a variety of voices, ours included, along the way in doing that. But no, we don't see a dramatic pre-buy, but we do see, solid order activity as we look, through the remainder of this year for sure, coming out of the current environment, Greg.
Yeah, it does feel like they, as you said, they listened to industry. They still, I think it's interesting that they kept the NOx reduction. Like, I lived in Hong Kong for a period of time during college, traveled the world extensively. Environmental regulation in America has gone way too far. A lot of NIMBYism, we could argue. But clean air is something, I'm an asthmatic, but just going to these places that don't have clean air, getting rid of, reducing NOx. It was interesting the administration kept the 90% reduction, but it actually pulled back, we'll call some of the more aggressive parts of that law that just felt unworkable, like the 400,000-mile warranty. We all know where that came from. That was a derivative of some other areas in emissions. But do you think the engine manufacturers are ready for this? I know they've been positioning. Do you think they're in a position to really deal with this new rule?
I mean, I can't really comment holistically on the various competitors in that industry, but I can speak for Detroit, right, which is obviously part of the Daimler family here in North America, and we're certainly comfortable that we're well positioned to step into that ruling and to provide a fantastic solution that offers also economic benefit for our customers. So we're happy to move forward on that and feel very well positioned from that perspective, Craig.
Yeah, I think getting resolution, anytime you have these sort of outstanding government regulations is always difficult. The Federal Reserve, there's been some question about Kevin taking over the Federal Reserve, the new Fed governor. What direction? The very first meeting we got, I think the public narrative was that he was just going to give in to some pressure for the administration and hammer interest rates and try to lower interest rates because that was what Trump wanted. That didn't happen. There was a change in orientation. Obviously, you guys are incredibly, on the front lines of interest rate. Any thought really on how fleets are thinking about interest rate policy and how that's impacting their decisions to purchase or not purchase?
I mean, I think we're kind of in the environment that we're in, and we see it relatively stable going forward. Yes, it was a time we expected potentially a couple of cuts, or the industry did. Less likely now, maybe one cut, I think might be the consensus over the remainder of the year. But I think, what we're seeing is that, our customers are being very judicious about how they're investing and spending their money. But investing in new equipment is part of that when it comes with, a value proposition and a payback. So I don't, see it as either an aid or a deterrent. I just see it as kind of the normal that we're operating in. And I would say, based on the consensus and our own internal thinking, we don't expect any dramatic change on that in the near term for sure, Craig.
Yeah, every decision is total cost of ownership in this business. And ultimately, you have a healthy freight market. As Tobias talked about, the freight recession ending, we are celebrating the end of that long winter that we've all been suffering from. So, fleets are definitely, feeling more bullish. We're going to hear earnings reports over the next couple of weeks. We talked about the fact banks are starting to upgrade a lot of the earnings reports. One of the questions I have in a post-Montgomery world, it feels like shippers are probably going to want to take more dedicated fleet capacities. One thing I would expect to hear from the public earnings is that dedicated is going to be a higher preference because it does insulate the shippers from the hiring decisions for negligent hiring. Are you guys, are you seeing private and dedicated come back as well? Or are we seeing shippers sort of sit on the sidelines and seeing what the market does?
Tobias, do you want to comment on that, or could you comment on that? I think you're closer
Sure.
to the data.
Thank you, Kevin. Yeah, we haven't seen that yet. I know what you mean, Craig. So we would expect the same, but we really haven't seen that in the market right now. And again, this goes back to really our customers just recovering. Let's not forget, like the 4 years have left a pretty heavy mark on everyone's financials. So I would expect to see that, but it's probably rather towards the end of this year.
Yeah, I think it takes a while for shippers to accept reality. I mean, earlier this year, because I know this because I get a lot of hate, a lot of shade on X, is there was a lot of denial from the shipper population and a lack of awareness. Julie, we talked about it.
Yeah.
Just didn't believe that this market recovery was real. There was the weather, it was the holiday. There was a lot of people who just did not believe we were in a real recovery, and a lot of it, I think, is just a lack of sort of seeing a trucker's market.
And the dedicated sales process and RFP process is really long, so it might take a little while.
How long does it take? A year? Is that a year plus environment?
I mean, the sales process, yes, a year plus. The RFP process, multi-month.
And are they only going typically for dedicated? They're typically going to the larger carriers. It's the largest carriers that are focused on dedicated, right?
Yeah, there are some pretty strong regional dedicated players as well who play very well in just specific regions of the country, certainly.
Yeah, I think we probably need a couple more months or quarters of tightness to fill, I think, where shippers will start to really, freight left on the dock is always a big catalyst for this industry.
Yeah. So topics of the week are, earnings and then also AI, right, for us this week.
AI is a perpetual discussion.
We know that, you guys are using artificial intelligence inside of your organization today. So what role do humans still play in those decisions, and how are you guys attacking AI as part of your business?
I mean, that's a great question, and it's certainly a topical one, right? And I would say that Daimler Truck Financial Services within the Daimler Group is playing an important role in that regard. But they're always, involved with kind of complementary with human decisions and human support, right? I think we see two primary kind of paths at the moment in use cases. And one is definitely about reducing kind of administrative burden and kind of ease of doing business, right, for our customers to free up more kind of focused time for direct, let's say, face-to-face involvement with the customer. So there's kind of that piece as an aid to having more focused time with our customers. I think the second piece that we're seeing a lot of power out of is rather more around kind of analytic predictability, right? And kind of looking at the lessons learned over the last couple of years as we went through such a significant freight recession and learning to kind of balance our portfolio in terms of, value and returns and predictability of that in line with kind of our overall credit performance. And I think we're making kind of big strides in that area that will only serve to kind of enhance the way we, interact with and do business with our customers going forward. So we see it as a key lever, just in summary, but rather as an augmentation, right, of our human capital and human skills that add value directly back to our customers and our relationship with our customers.
So we have a lot of fleet owners. We also have a lot of owner-operators that watch the show to learn how to operate their business. But I'd love for you guys to comment, maybe a piece of advice that you have for those smaller fleet operators that are out there. What is it, one piece of advice that you wish that they knew going in before they financed a truck?
Tobias, do you want to take that?
And maybe, Craig, I'll take that. Yeah. So being prepared, like we want to help them, right? This is not, we're a captive and we serve the interests of our OEM. So we actually want to get, especially the smaller guys, into a truck. So they can help us by just being prepared, right? I mean, having financial statements ready, having a list of customers ready, like really basic stuff. But it tremendously helps us if we don't know each other. There's this industry, everyone knows everyone. But if you're new to us, it helps for us to understand, what you're about, who you're hauling for, and where does your revenue come from. So really basic things, and then help us so we can help you.
Come in with a complete file, demonstrate that you know this industry, know the cycle, because it's a brutal industry if you're not prepared for it. I think we saw a lot of growth in capacity among small operators over the last years. By the way, the sales operations and the OEMs love the owner-operators regardless of what they think, because this is where the higher margin trucks are. The big fleets are ordering a lot of trucks, but you guys really love those small operators because they keep our nation going. Well, appreciate you coming in today. Lots to talk about. Man, there's so many questions that I had that we just didn't get to. Unfortunately, we're out of time. That is the folks at Daimler Truck Financial Services to keep our truck drivers and our operators funded and financed. It's so important.
It really is.
We'll be right back on FreightWaves Today, and we're going to get into the Sonar update here shortly.
It's National Safety Month, which makes this a great time to ask how your fleet can prevent more accidents. Samsara AI detects risks in real time, giving teams more visibility into what's happening on the road and more context to coach drivers before risky moments become incidents. Fleets using Samsara Complete AI Safety Solution have reduced crash rates by nearly 75%. See the data behind the results in the Samsara Safety Report at samsara.com/freightwaves.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara Driving Coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on Masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited and I hope to see you in class.
Imagine a world where your freight moves as fast as a digital pulse. What if your visibility didn't just tell you where a truck was, but exactly where it needed to be 48 hours from now? Think of a logistics network that corrects its own mistakes before they cost you a single dime. What if your supply chain could think for itself? Imagine AI agents negotiating rates in milliseconds, predictive models that solve labor shortages before they even happen. This isn't science fiction, it's the agenda. On July 15th at the historic Old Post Office in Chicago, FreightWaves presents the Supply Chain AI Symposium. We are defining in real time how AI is embedded into every mile, every warehouse, and every handshake. Because in 2026, the future isn't just coming, it's already negotiating. The FreightWaves Supply Chain AI Symposium. Secure your spot now.
All right, welcome back. Earlier this morning, Craig did a dive into the Sonar data. Let's take a look.
We kick off earnings for the quarter, for the second quarter. It's a really important week because we get a sense for how the largest trucking and transportation providers are seeing the market and what their expectations are going forward. So we look at these reports as really the most important signal for the largest of the large operators. And J.B. Hunt is the first to go. J.B. Hunt is arguably the best operator in logistics. They have the most diversified and differentiated business of really any of the providers. Their intermodal business, which is the largest and most important part of the J.B. Hunt model, combined with their last mile operation, their dedicated operation, their logistics operation, and their for-hire truckload operation, J.B. Hunt's diversity of their business really brings in all price points and enables us to really understand what the overall market's seeing. So it's an important barometer for market activity. It's an important barometer for what we can expect to see throughout the rest of the earnings cycle. They also tell us, all of these motor carriers that give us the public reports, are going to tell us about what their expectations are for the second half, what they're hearing from customers. What we should expect to see and we should expect to hear is that J.B. Hunt's, particularly their intermodal business, domestic intermodal business, is doing exceptionally well. The reason I say that is we can see it in the intermodal data that we have inside of Sonar, is that domestic intermodal has picked up a lot of steam over the last couple of months, largely because of the cost of fuel and the tightness in trucking capacity. Shippers are taking advantage of the domestic intermodal. J.B. Hunt has far more exposure to the domestic intermodal than the international intermodal, and therefore when we look at the overall sort of state of intermodal, we really want to zero down to that domestic volume, the domestic activity, because that's really what drives the J.B. Hunt earnings in its intermodal business. What we also look for is conversations around dedicated. Now, this is something that I think is really interesting, is the Montgomery case does put some pressure on shippers in terms of whom they're doing business with. And while they don't want to necessarily ramp up the hiring operations of their own truck drivers, and there will be some of that activity, one of the things that I think we'll see is demand for dedicated trucking operations. And really what drives that is the lack of capacity, the high freight rates that you see in the overall spot market, as well as the contract market. Shippers, if they get concerned about capacity availability, tend to want to build out their dedicated operations, and I expect we'll hear that from J.B. Hunt. But also the Montgomery issue means that shippers need to demonstrate in front of the court systems, because there is the potential of shippers being brought into courts and being sued for negligent hiring. Shippers will want to show that they have done their work, and they really being able to manage who they hire is really important. So that will drive interest in using highest quality motor carriers. But what it also does is shippers also want 1 degree removed of liability. So if they hire these people directly and they end up in an accident, it could be a nuclear lawsuit, and we've seen what happens. You can go back and look at the Mesilla Valley issue. You can look at the QXO issue over the last couple of months. Seeing some big nuclear settlements or lawsuit awards. We also we know that this is going to increase after in the post-Montgomery world. I think what's going to happen is that shippers are going to want 1 degree separated. The best way to do that is to have a dedicated fleet operation. I want the advantage of private fleet, and to be clear what we mean by dedicated. These are effectively contracted drivers. Oftentimes, the trailers look like the company, so you could have a company like Target is a big one, Dollar General is a big one, that basically it's their trucks, it's their drivers, at least it's flagged that way. The liveries are flagged to look like another company's fleet. The drivers may even wear uniforms related to that company. So to a consumer or to a pedestrian, it looks like it's working for, that driver works for Target or Dollar General. In reality, they're working for an outsourced company. In this case, we're talking about J.B. Hunt. J.B. Hunt's dedicated operation is really important. It's a big piece driver. It's also effectively an annuity. I mean, it's a really nice business for large asset carriers because basically it's almost a cost-plus environment where they can go in and manage the operations on behalf of the shipper. They get really all miles covered. They get paid on a per week basis, and then some variable costs with markup included. It's a fantastic business, but it's been the last couple of years, because of the softness of the spot market, a lot of companies have rotated out of dedicated and moved their demand into just the overall for-hire market. I think with the tightness in trucking capacity combined with the liability issues, dedicated will probably be a big growth market, and there's no better company position to take advantage of that than J.B. Hunt. They have their brokerage business. Brokerage is their ICS business. And while it's an important part of the overall J.B. Hunt story, it's been one that, due to a lot of market issues, the high spot markets instead of run on the market, it's been one of the more challenged part of their operation. Will we see progress there? It's something to watch for, and certainly something that I think will tell us a lot about the state of the freight market. The last thing we're going to hear about is their for-hire trucking business. This is one of the smaller parts of the overall business for J.B. Hunt. It's really independent contractors today. It's no longer hire drivers, it's independent contractors. And the recruiting market for independent contractors is incredibly tight because what we've seen is that as we've churned out a lot of the non-domiciled CDL drivers, a lot of the drivers that previously were working for those fleets the legit drivers, we'll call them, the regulated drivers, the registered drivers, have gone over to those fleets that have been hiring non-domiciled and non-regulated drivers. And so they've ended up there, and that's created some constraints of capacity. The other thing is, as the spot market heats up, a lot of the independent contractors decide they want to really go out truly on their own and will end up running their own for-hire operation, taking advantage of high spot rates. So these are interesting developments, and we'll hear how J.B. Hunt has responded to that. And then last mile is largely related to big appliances and consumer businesses. That's probably the most stressed part of the entire story, not necessarily for J.B. Hunt, but just the overall economy, because big discretionary, we've heard a lot about the appliances from companies like Whirlpool have been struggling in this economy. So it's probably some part of the market or part of J.B. Hunt's story that may be more challenged, largely because of the economy. And really what drives that last mile business is the housing market. And because as people are buying these big bulky items, and we say last mile, that's what we're referring to, they're just, if you're not buying a house, you're not moving homes, you don't need a lot of furniture, you're not buying big TVs, you're not doing the types of things that you traditionally would do and would drive the last mile business. And so I would expect that probably one of the more stressed part of the J.B. Hunt portfolio. But ultimately, investors, what they care about is the state of intermodal, the state of dedicated. That's really what they're going to really hone in on, because that tells us a lot about not only J.B. Hunt's business model, but the overall freight market. And so I would watch those points, and I would expect we would have fantastic reports from J.B. Hunt, as well as many others. But again, it's the J.B. Hunt report that we really want to look at, because it does set the tone for the entire freight market.
All right, Craig, good update. And we'll be talking more about earnings as the week progresses. But let's talk about this recent post from Donald Trump on the Strait of Hormuz and what you think this means.
Well, he wants to be the I think Guardians of the Galaxy, but Guardians of the Hormuz is really what he's describing himself as, or the United States. Look, it's a tax. It's a 20% fee is what he's proposing, or at least threatening. I don't know if threatening is the right term for this. I mean, it does feel like look, there's a bunch of arguments here. One is that this is the United States, and this has sort of been the Trump doctrine, is he feels as if the U.S. military has been taken for granted. We fund it, American taxpayers fund it, to keep the world's oceans open, trade lanes open, safety. The U.S. Navy is the most powerful military force in the world in terms of protecting the oceans. And Donald Trump believes that we have been getting the raw end of the deal. And I think two reasons to this. One is, I don't know that this is enforceable. Like, international maritime law basically says you can't enforce it. What Donald Trump would say is, look, I've got battleships. I'm the ones that directs the U.S. military, and therefore, I don't know what's going to happen. I mean, one of the things about America is that we're a nation of laws. Yep. And so I don't know if this holds up. I mean, there's all these treaties with the international IMO. There's all these international treaties. So it doesn't feel legal.
Yeah.
Well, but I don't know that Donald Trump really cares whether or not that So look, ultimately, this is about putting pressure on European and
That's
Asian
what I was
allies.
going to say. So he's an interesting communicator. His methods of communication are interesting.
You think?
But I mean, that's really what this is about. This is really about asking for support for beyond just the U.S. military to be put, to be spending all of the resources and putting
we only get 2%.
All of the pressure on Iran to keep the Strait of Hormuz open.
We only get 2% of our energy from the Strait of Hormuz in the United States. And so there's an argument that the primary beneficiaries are Europe, Asia, and should they be carrying more of the bill? I think I can make that argument. But the practicality of this, what happens if you don't pay? Do you get blocked? I mean, I'm sure that because he is the commander-in-chief of the armed forces, I assume he can just direct the Navy to block those ships that aren't paying it. I don't know. So a lot to be done, a lot to be talked about.
Yes.
I tell people this all the time. We've covered Trump for at least 10 years. It's hard to get excited about any single post and to read too much into it.
Right.
Because ultimately, a lot of it is he says things that don't necessarily come to pass.
Well, yes.
It's a feature, not a bug,
right? Yeah. Okay. Great. Well, we are going to hear from our sponsor, Highway now, by digging into a recent case that's been in the news. Indiana State Police say troopers have recovered about 12 stolen truckloads since April. The agency values the recovered freight at more than $11 million. Recoveries span north central, central, and south central Indiana. Troopers involved recently completed cargo theft training, and investigations remain active. Police say organized groups are using chameleon carriers, and forged documents to pose as legitimate carriers. Investigators have also found stolen USDOT numbers and repeated load rebrokering used to disguise the fraud. Police recommend verifying carrier details and confirming any rerouting requests before releasing freight. Our Fraud Watch segment, Verified, is brought to you by Highway. All right, we are going to take a quick break and be right back with Mark Fittner, our chief economist of Piedmont Crescent Capital.
Yeah,
we're going to
talk about the economy. I'm sure Mark's got some thoughts on her move. We'll be right back.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara Driving Coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
Welcome back to FreightWaves Today. We have Mark Vittner. He's the chief economist at Piedmont Crescent Capital. Mark, welcome to FreightWaves Today. A lot to talk about the economy.
Absolutely. It's a real open book today.
I don't know if you caught the story earlier, but Trump has threatened this 20% tax, we'll call it, as the guardians of the Hormuz, as he describes it, the 20% tax on basically there's this fee that we're going to charge. Again, we don't even know if this is legal, but let's suggest that this does go into effect. And he orders the U.S. Navy to actually detain or block any ship that doesn't pay this fee. What do you think the repercussions of that globally in the economy are?
Well, I think the question would then be, well, what's next? I mean, where would you put the next fee and toll? I mean, why not put it somewhere else? It's not the only choke point that the United States Navy is protecting. So I really think this is just aimed at showing how absurd it is for Iran to try to charge a fee. Say, hey, if you're going to charge a fee, then we're going to charge a fee too. And they're going to make it so expensive for you to ship oil out of there that nobody's going to buy oil from you.
Well, one of the things about covering Donald Trump is if you have something, if someone's like, I think Hillary Clinton talked about she was going to build put $1 billion into an airport or into a bill, and Trump's like, I'm going to do 5 of that. So he's always got to have the bigger message. And look, if they get their piece, if Iran suggests that they want a fee, Donald Trump's like, look, I want my fee, but I want it to be bigger. That is the Donald Trump playbook. A lot of it's posture. We can't get overly excited about any of these announcements because you just never know what they're going to happen.
Yeah, I think the thing that I always tell people to remember when you're thinking about Trump is that he's always negotiating. So everything's a negotiation. So it's not. I don't think the markets pay that much attention to this. I don't think it's not likely to be the outcome that we see, that we have some sort of a toll on shipping through the Gulf. I do think it's totally unacceptable for Iran to put a toll on there too, and I don't think there's any outcome where that's going to happen. Yeah,
for sure. Well, Mark, let's talk a little bit about the economy. Things aren't getting much better. We've covered it extensively, particularly on the industrial side. There's a lot of data that suggests that this recovery, this industrial recovery particularly, is getting broader. You can see it in the rail data. I mean, we're starting to see bulk commodities really expand in terms of volume. What is your read on it?
Well, we're certainly seeing it. We've seen it in the ISM report, which is one of my favorite economic indicators. It comes out the first business day of the month. It picks up the breadth of the strength of the manufacturing sector. When it's above 50, it means more manufacturers see things getting better than see them getting worse. And it's been strong the last 6 months. And on top of that, we've seen follow through in the employment data, where a rising share of manufacturers have been adding employees. And then we finally saw it in the employment data. I mean, the monthly employment data are a little volatile, and there's some big revisions to it from month to month, but we are seeing an improving trend there. So there seems to be little doubt in my mind that the manufacturing is improving. Typically, the manufacturing sector is where the economy gets its cyclical impulse. And when manufacturing activity turns up, GDP tends to surprise us to the upside. And so I have a pretty strong forecast for the second half of this year and for next year. I think we have 2.7% GDP growth for next year and 2.5 for this year. Pretty solid gains. And the only thing that gives me some pause is that if the war with Iran gets back on and oil prices go back up to $90 plus, then we don't get the break that we were counting on in the second half of the year. If oil stays closer to $70 a barrel, then consumers are going to be spending less money on gasoline. They'll have a little bit more money to spend on everything else, and we should see consumer spending pick up. And that would go a long way toward improving freight volumes, because where we're seeing the most of the strength right now is on the capital spending side. And it's a lot of stuff that goes on a flatbed of a truck, but it's not a whole lot that goes back in the vans. So,
yeah, I mean, look, I think we've had guests that are on more of the consumer retail side. Is volumes have been pretty good. We haven't seen massive growth, but even import volumes actually look pretty good. We are seeing in the industrial side. I always look at the rail data because those bulk commodities is a fantastic leading indicator for what's likely to be coming out of a factory in 6 months from now. And we've seen ramping. We had the CEO of the AAR last week on talk about how broadening this recovery and industrials are. One of the things that get asked a lot, Mark, you touched on it, is the employment data. There have been some reports, if we go back to November, which is where we saw the real turn in the freight market, according to our data, the real firming of it, we didn't see really employment start to really firm up in the manufacturing sector until really April of this year. Why is that? Why do we have such a significant lag between those two data points?
Well, there is a little bit of a lag in hiring, because typically what you see is that orders improve, then order backlogs begin to lengthen, and then companies begin to hire. So and before they begin to hire, hours worked increase. So you see that they work their existing workforce a little bit longer, and then finally they hire. And the other thing to keep in mind is that when you think about manufacturing today, it's very capital heavy and employment light. So that you can boost output a lot without adding a whole lot of new staff.
Yeah, that makes a lot of sense. So we're talking a little bit about consumer spending, the GDP, and retailers, as well as inventory levels. I think I read in some of your information, we're getting to a point where there's going to have to be some restocking and replenishment of that inventory. What do you think that looks like? What do you think that time frame is? I know you mentioned this morning, we'll see what happens with oil and what that does to consumer sentiment. But what are your thoughts around that?
Well, there's two big questions. One is oil. I mean, and I think that if nothing else, there was this big debate. I would listen to people all the time, and they're like, for every week that the strait is shut, it's going to take 10 more weeks to bring prices back down. And then lo and behold, we get a deal, a very loose deal. I mean, the memorandum of understanding was not a deal, yet prices plunged. Because the one thing people tend to forget is that the markets are always forward-looking, and they built in that, hey, we went into this thing very oversupplied. We have drawn down oil inventories quite a bit, but there's a lot of production. All the new production that came online in South America and Africa is still going to be there when the Middle East production comes back online. So I think that's one of the things to think about in terms of energy. The other question on inventories, though, is that consumer goods companies are still holding off. I mean, the K-shaped economy is still there. We have upper income consumers seem to be doing relatively well. They're continuing to spend on experiences, travel. One of the things that I think gets understated quite a bit is that we also have this huge surge of baby boomers that are retired or partially retired. And they don't necessarily show up as high earners, but retired people don't buy a lot of stuff. They travel, but they don't buy a lot of stuff. I always tell people, when you visit your grandparents, they had the same couch they had 30 years ago, and maybe even the same TV. So that's a big part of the economy right now. And then on the other side, where we've got younger workers that are coming in, there's a lot less confidence about the labor market, although I think even that's a little oversold. So I think the inventory cycle is going to be slow to get going. And then lastly, there's housing. And right now, we're in one of the weirdest housing markets we've ever seen, because most people are talking about how we have a shortage of housing. Yet if you talk to any home builder, they're like, oh, we don't have a shortage. We have too many houses, because housing inventories new home inventories are higher today than they've been since any time since the financial crisis. And we do have a affordability problem I think everybody agrees on. But right now, we're seeing a lot of weakness in the home building industry. And so any type of product that's being hauled for building new single family homes is not likely to recover that soon. Furniture is still very weak because existing home sales are actually lower today than they were during the financial crisis, because there's just not a lot of supply out there. So until we get a better idea of what's going to happen with housing, I think that anything that's tied to home sales, which is furniture and appliances, I think folks are going to keep fairly lean inventories. And unfortunately, I mean, in the very near term, we've seen that the number of people that are locking in mortgage rates has gone up, which is a good sign that home sales are likely to improve in the next couple of months. And the one caveat with that is the reason why people are locking in is they're suddenly becoming scared, saying, you know what, I've been waiting for rates to go down, and it looks like the next Fed move is going to be to the upside. So maybe I better go ahead and lock in a rate now and move forward with this home purchase. So we may see some activity pick up in the next couple of months, which is just reflects people trying to get ahead of rising interest rates.
You know, Mark, it's interesting. The LMI report, which we track, the Logistics Managers Index, did report for the first time a change in inventory levels. The retailers are starting to build more inventory. And that's a fantastic, the LMI is a fantastic indicator. The retailers are starting to get more confidence in consumer staying persistent. Is the read on the authors that published the report talked about the fact that, you know, upstream, which is really manufacturing, is not taking a lot of inventory in because I think there's more orders than they have in terms of, that's why production should continue to expand. But when you look downstream, which is retail, they're starting to see an expansion in inventory levels. And the authors read on this, looking at really the commentary, is that a lot of that is retail confidence. They thought the consumers were going to drop off significantly in the second half of last year. There's a lot of noise around Liberation Day tariffs and policy decisions and DOGE and all this sort of noise that we got from the sort of changeover administration. Consumers still stay persistent. And inventory levels were really tight, but they're starting to see a build of that. You know, the question is, are they going to overcorrect? It's not what the authors are suggesting. They're suggesting the opposite, is that they're gaining confidence in consumer persistence and therefore adding inventory to reflect that. And you see that in imports. I mean, that is an interesting sort of counter to what you're talking about, because it feels like maybe that's an early sign that isn't in some of the broader government data.
Well, I think you have it right there, in that I think that there were so many things to be worried about that caused retailers to be more conservative than they probably should have. Because the one thing that I've learned in doing this for 40 years, which is amazing to me, 40 years, is that you should never underestimate the American consumer. There's only one word that the American consumer does not know, and that is the word no. I mean, consumer spending almost always surprises us to the upside. The only time that I really saw weak consumer spending was in the throes of the financial crisis, which was understandable. But I started in this in the early 1980s, and we've had some very rough times. Every time the stock market would sell off, I remember the '87 sell-off, and people were like, "Oh gosh, consumers are going to pull back." There wasn't anything. In fact, after the Fed cut rates, they started raising them 3 months later. So it was American consumers are incredibly resilient. But what's a little bit different right now is that housing seems to be stuck. It seems to be stuck in low gear. And a lot of it is that people are holding on to homes because they have 3% mortgages and they don't want to give them up. And those people are living in homes that are highly desirable because they're in great school districts, but they don't want to move. And so you've got people that can't find homes that they need. And so everybody's kind of stuck in place. And housing drives a lot of spending. And when you buy a house, you refurbish it, and then you buy furniture, and you buy appliances, and you buy a grill, and you do all sorts of fun stuff. So it's if we could get housing going, then that would really kick consumer spending into high gear. What I think is happening now, though, in terms of the inventory rebuilding, is that the worst case has been taken off the table. That folks are saying, you know what, I don't think that energy prices are going to shut down consumer spending. I mean, we've probably seen the worst on that front. And so folks are building a little bit more inventory going into the second half of the year. But it's selective. I mean, one of the things that we're going to be watching the next few days in the inflation numbers is what happens to consumer electronics prices, because they've been falling for over 20 years. And there's a good chance they're going to rise, at least in the aggregate, when we see the CPI data.
Yeah, but a lot of that is, related to semiconductors and just the competition for chips is driving a lot of the consumer product and consumer electronics. The good news is it's not a huge driver of freight demand. It's big ticket, but it doesn't drive. Ultimately, as you talked, I think the housing market, we estimate as much as 20% of freight is indirectly related to housing, carpets, appliances. My Sonar update covered all that, how, J.B. Hunt has a last mile business. A lot of that was the old, I believe, Whirlpool last mile delivery business. People, if you're not buying homes, you're not buying washing machines until it breaks. You're not buying, appliances. you're not replacing, like you said, the couch if you're not buying a home. So that's an important, I think it's an important stimulus for the trucking market, and hopefully we will pick it up. What is the reason that we're not seeing housing expand? Like why, other than we know interest rates and affordability is a problem, is there any other thing in the data that suggests, you mentioned demographics, is that part of the story?
That's part of the story. And what you see is you have a lot of people that should be downsizing their homes, but since they have such a low mortgage rate, and since there's not a lot of houses on the market, they're really stuck in place. They're like, well, I can't really find another place that I'd like to move to where it would cost me less. And I've got a pretty good deal right now. So why don't I just stay put? And that's what's happening across the country. That's a big issue. And I think that one of the best hopes we have is that maybe in the next big, beautiful bill, I don't know if that's what they're going to call it, but in the next reconciliation package, there's talk that they want to provide further relief on capital gains taxes so that there would be an incentive for people that were sitting on a 3% mortgage saying, well, you know what? Yeah, I'd have to take out a mortgage, but I've got a lot of equity here. So maybe I would have to have as large a mortgage and I could, basically have lower living cost, and so that we could get some activity in the housing market, because you really have to. We have to get more inventory. We have to. It's hard to get things unstuck because it's not just one piece of the puzzle that we have to work with. The other issue we have, though, is at the entry level. There's not a lot of builders that are building entry level homes, and every time I hear people say, "Well, the problem with housing is that we have institutional investors," and I'm like, "Well, that's really not." That's not the problem. There are some issues there, and a lot of Sunbelt markets, institutional investors are buying up all the homes that are priced around the median. And so it's very tough for somebody to compete against an institution because they're paying cash. So it's an issue, but that's not the only issue. Another issue is that it costs a lot to get all your entitlements in place and you pay for all the infrastructure improvements. And it costs a lot more than it used to, mainly because about 20% of retailing is online now. And so we don't get as many Targets and Walmarts and Home Depots. We probably get as many Home Depots as we ever did, but we don't get as many, we don't get as much retail as we used to. And because of that, housing has to pay more of the cost of infrastructure. They have to pick up more of the cost. And we just, that's an affordability shock that's just, that's hard to recover. So you've got about $160,000 to $200,000 of fixed cost before you have any lumber or any labor building a home. So it makes it very hard to build an affordable affordable house.
NIMBYism is going to kill us all. It's the biggest drag on the U.S. economy is just this NIMBYism of I don't want to build things, I don't want to permit things. It's absolutely a drag and keeps America from operating at its best. I got to ask before we go, there's a report that I read, there's a media business called the Randall Report, which talks about expansion. Last year was one of the lowest numbers of industrial announcements in the South since he's been reporting this since 1980. This year it's been completely opposite. Like we've seen a massive amount of new industrial expansions happening, these Southern projects that's really starting to drive. You're a Southerner living in North Carolina, we're Tennessee, and we're all rooting for the South. What do you see in terms of new expansion?
Well, yeah, I'm sitting in North Carolina, and North Carolina is both North Carolina and South Carolina. Their economy is just fantastic right now. But I think that what happened last year is that we were adjusting to a new president. And you looked at what happened under Biden. We had a lot of incentive-driven projects for clean energy and for EV projects and for chip projects, for that matter. And whenever you have incentive programs, things get a little overdone. So we had some EV plants that didn't quite make it. And we had some chip plants like Wolfspeed outside of Raleigh, which has had a lot of problems getting up and operating. And the president ended a lot of that. Trump ended a lot of that. And so now EV projects, if they're going to move forward, have to stand on their own. So there was a little bit of a pause there. And so the things that were really driving the economy in the prior years came to an abrupt slowdown. Trump was out there, winning a lot of commitments for foreign direct investment, but that stuff doesn't show up right away. And now a lot of that stuff is showing up. There are a lot of data centers mixed in those totals, but Mike Randall doesn't like to. He doesn't like to include the data centers. He really wants to have the industrial projects, and we're also seeing that some of those EV projects like Rivian in outside Atlanta that has come back online. So it's going to be viable in its own right. Scout Motors is under construction and set to begin production in 2027. A huge factory they're building outside of Columbia. And both of those are more hybrids than the traditional EVs. And so that if you can't find a charging station, you can just fill it up with gas. And so that gets rid of the range anxiety. So things are looking a little bit better there. But I think he has it right this year. We're seeing very strong momentum throughout the South, and it's evident just about in every state.
Well, I like the fact that you read Mike's stuff. It's amazing. His point is, if you're not seeing big expansion announcements in the South, you're not going to see it anywhere else. This is the most desirable place for capital to go in terms of foreign direct investment. Lots to talk about. Really appreciate it. I think we're going to get the big, most beautiful bill because Donald Trump can't stand having
biggest,
something.
Most beautiful bill.
The biggest, most beautiful bill is what we're going to get, and then next year we'll call it something else. We'll be right back. We've got Christopher Versace with us. He's the Chief Investment Officer of Thematic Strategist. We'll be right back.
Race car drivers like NASCAR champion Jesse Love are a lot like uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on Masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited and I hope to see you in class.
Imagine a world where your freight moves as fast as a digital pulse. What if your visibility didn't just tell you where a truck was, but exactly where it needed to be 48 hours from now? Think of a logistics network that corrects its own mistakes before they cost you a single dime. What if your supply chain could think for itself? Imagine AI agents negotiating rates in milliseconds, predictive models that solve labor shortages before they even happen. This isn't science fiction, it's the agenda. On July 15th at the historic Old Post Office in Chicago, FreightWaves presents the Supply Chain AI Symposium. We are defining in real time how AI is embedded into every mile, every warehouse, and every handshake. Because in 2026, the future isn't just coming, it's already negotiating. The FreightWaves Supply Chain AI Symposium. Secure your spot now.
Welcome back. Logistics and transportation stocks are absolutely in focus as we get into earnings season, and we have the perfect guest here to talk about that. We are joined now with Christopher Versace, Chief Investment Officer and Thematic Strategist at Tematica Research. Craig and I are both struggling to get some words out today. So tell us about what we can expect starting this week with earnings season.
Well, Craig and Julie, thanks for having me. It is the start, really, of the second quarter earnings season. It's going to kick off tomorrow. We're going to have a range of big banks, everybody from Goldman Sachs, JP Morgan, Citigroup, Bank of America. Wednesday, we have a few more with Morgan Stanley. And then Thursday, we're going to hear from a company that's going to be, I think, very, very important, given what we've seen in the market year to date with AI and data center demand and semiconductor capital equipment. I'm referring, of course, to Taiwan Semiconductor. And what they say about the back half of the year is going to be very influential for, not only chip stocks, but, again, their ecosystems, food chains, and candidly, a lot of the reshoring products that, customers and of trucking companies and the like that you track will be paying attention to.
Chris, Taiwan has become bigger than China as America's trading partner, which is really just a reflection of how these semiconductors and GPUs are performing more so than anything. I mean, look, we've seen Samsung's report was insane, absolutely blew it out of the water, but they sold off. Do we think we're at a point where investors just are so priced for perfection that they continue to have unrealistic expectations of growth?
Yeah, well, look, we've come from several quarters of demand has been far stronger than expected. And, investors tend to look back and say, we know things are strong. The question now is, are they continuing to be stronger than we expect? And I think we're going to see that. This morning, Taiwan Semiconductor came out. They reported their June revenues up 68% year over year. But if you look at it, even on a different venue point, sequentially up 6%. If you look at the trailing 3-month data, right, it accelerated. June was faster than what we saw in May, which was faster than we saw in April. So we are seeing this acceleration happen. Where I think it gets a little dicey, Craig, is that, like I said, investors have kind of caught on. So, they've ratcheted up their expectations. Now the question we have to ask is, are we going to see numbers that just, squeak by when companies report and they guide? Or is there profound upside that people can get re-excited? My suspicion is, however, that we're seeing, the chip sector fall off. You can look at the tape today and you can see that. But I think that once we get through the earnings season, we learn what hyperscaler CapEx is going to be. We're going to see what neo-cloud capital spending is going to be. Folks are going to circle back to these names, looking for value, looking for reasonable valuations. And I think that's the time that folks who are listening should start to wade back into those names if they aren't in them already.
Yeah, I think everyone's wondering, is this a bubble? And I think for us, specifically in freight, we're wondering, does the bubble, if it pops, if it is a bubble, and I think this is, this isn't something that we sort of have a view on whether it is a bubble or not. One of the things that I think, though, if the bubble were to pop, the construction of data centers would be absolutely catastrophic to this freight market. The loss of construction of data centers, I should say, would be absolutely catastrophic because that's driving a big piece of the overall freight market. As much as 7% of flatbed, amount of capital spending that's going into these big projects would be really, really, I think, create a pretty substantial hangover in the trucking market specifically because you wouldn't have the demand. And that's what's we believe, a lot of the industrial renaissance is this AI data center, big CapEx spend, not only in data centers, but also in energy and power.
Yeah, no. And increasingly in water facilities as well, right? Because water is, of course, another issue that data centers have to deal with. Look, when you're asking the big question, are we in a bubble or not? And I can tell you that late last year around the holidays, I kind of sat back and I traced what we were seeing and compared it to the rise of the internet. And, lo and behold, with the internet, there were two things that we needed to differentiate from. One was adoption. Are you connected to the internet? But it's the other one, usage. How are you using the internet? That really, I think, makes a big difference. And I think the same thing is going to play out with AI. So the questions are, at least to me, Are you using AI? And we are seeing that adoption rate continue to tick higher, both with consumers, enterprise customers, and in other agencies like governments around the world. So that's good. But we're also starting to see the usage expand. And just think about it for a second. If you were to teleport back into a time machine, and I don't want to tip my hand on my age here, but if you were to go back to the mid 90s and you first looked at Netscape and you were like, wow, this is a pretty neat thing to look at, but I can't do anything. It was essentially, in its very early days, a digital catalog on your screen. But over time, right, we were able to transact, shop, for example, pay our bills, stream, connect the way that we're connecting now. So much like we saw with the internet, I think with AI, there's going to be a widening out of applications that people are using it. That is going to drive uptime. That is going to drive the demand for AI and data center density. And I think that we're, not to use the baseball, parlance, but, are we in the second inning, third inning? Probably closer to the third inning at this point. But I think we've got multiple years to go. And when we take a look at some of the building that we're seeing for capacity, or we hear from comments like SK Hynix CEO, who says we see memory capacity constrained all the way into 2030, if not past. Micron is seeing something similar. It tells us that from different angles, we have more room to run.
Well, let me make the case for why I think this is the earliest of innings and why we're continuing to be bullish, and this is going to go on for many years. Something like 8% of data centers that have been announced and contracted are under some form of construction. So we have a lot of pent-up capacity. Maxonomics, which is a podcast that really breaks down consumer, is part of Morning Brew, but he did this fantastic story on this. What happened during the dot-com days was dark fiber, was the idea that they were building so much fiber capacity that we overcorrected. And that's one of the big catalysts for the decline in the stock market. The bubble bursting was this massive CapEx that we overbuilt because we didn't have the applications or the need. I mean, there was no Netflix or YouTube in those days that was streaming video. And we way overbuilt capacity. And we took out a lot of debt to do that. These companies didn't have the cash flows. The difference, though, in an AI data center is that there is no excess capacity, is that effectively, whenever I'm doing something through an AI, and I've seen this, if you go to Claude, like I've heard comments just in the past week internally, but also externally, like sometimes it takes a while to get an answer. Like there's a timeout issue that's happening, is that there isn't all this excess capacity, is that people are adopting these technologies so quickly and using it and adapting the way that they work so quickly that there isn't like these data centers and these GPUs that are sitting dormant that are waiting to use, unlike the dot-com days where it was being massively built out and the demand cycle wasn't there.
I think you're right. And let me just share, I was at a gathering over the weekend, and I was chatting with somebody, and they shared this point right now that I'll mention to you, which is that they had some customers of theirs that are in the federal government, and they are looking for Amazon in particular for more capacity. And Amazon said, we're tapped out. We can't do it. And the way the story goes, the folks from the federal government were saying, look, we will pay more. We'll pay double. We need the capacity. And Amazon's like, look, we are tapped out. There's nothing we can do until we get more capacity on stream. I think that speaks to what you're saying. And when we look at the other metrics of that AI adoption and expanding usage, and we look against the comments from the hyperscalers, I actually think that we're going to see another leg up in capital spending in the back half of the year because they need to bring that capacity on stream faster than they previously thought.
Well, there's so many people I talk to it's interesting because I feel like X is its own world where if you're on X, you feel like you're behind the times because you're seeing all these people talk about applications. If you're on LinkedIn, they barely heard about AI. And if you're off of LinkedIn, you talk to most business owners, small business owners, they don't even know how to start. Some of them are like, wait, they've never used, or they used OpenAI when it first, ChatGPT when it first came out. Mm-hmm. And they're like, hey, this doesn't work for me because they have a 3-year-old, they haven't looked at it in a couple of years or used it. And they don't realize how much better these technologies are, but we're still so early. And I know in our own use here how much application use and outcome we get in terms of actually solving problems or delivering solutions. But I'm still learning about this technology every day and how useful it can be. And you know, running a media business, I talk to a lot of publishers, and media is one of the most, I'll call, exposed to AI. I talk to a lot of companies that don't even know how to start because there's this sort of risk of offending their teams or not knowing how to use it in a way that's productive and enables the teams to really sort of embrace it. It just feels like we're so early. I have a hard time, Chris, making it. And I would also say this NIMBYism, which is really attacks on the American progress and our desire to reindustrialize. NIMBYism of blocking these AI data centers might be the best thing for the capital long-term investment because it forces us, is in many ways a governor from overproducing too much capacity too quick.
Yeah, I mean, look, it's all about being disciplined, and you know, we would like to think that companies have kind of learned, you know, the lesson of time, avoiding the mistakes of the past. There might be a couple that, you know, don't do that, and I say that in part because I think right now we're kind of in an arms race, especially among the hyperscalers for that capacity. You know, so you see them inking deals for power, for water, striking relationships with nuclear providers as well as they forecast out what they will need, not the back half of this year or 2027, but, you know, several years out. I think the concern that people have, and this is something that we've seen before in the heavy truck industry, companies like Freightliner, PACCAR, for example, names I'm sure you guys are very familiar with, that, you know, when you see a large ramp in truck orders as the economy revs, if it starts to slow down, the concern becomes one of cancellations in the backlog. In the case of AI and data center, you know, these are firm contracts, and I believe that they are being very methodical about the capacity that they need to bring on stream.
Yeah, it's a great point. I mean, the trucking cycle in itself is very different. These trucking companies don't have the operating at 2 to 3% margins in a good year. They're much more hypersensitive to the cycle. These are the buyers of these building companies that are building these AI data centers that are paying for it. Really, price is agnostic. They're not cyclical businesses.
No, you're right.
These are perpetual growth. These are the most profitable businesses in the history of mankind that are actually deploying the money. This is not the government spending to build out this infrastructure. These are private businesses with enormously large balance sheets. It's not the .com days where you get pets.com or, you know, even mentioned Netscape. Netscape was a small business. Maybe one of the most impactful businesses in terms of the internet, but a very small business relative to the types of companies, Microsoft, Amazon, Oracle, that are building out these hyperscale data centers.
Well, think of, you know, what Micron has said, and, you know, even Samsung to some extent, that the demand for AI and data center memory is so strong that we need to pivot our production to serve that market. And there will be capacity constraint issues for smartphones, PCs, and other consumer electronic devices. So when you hear that, and you step back and you go, wait a minute, they're saying to key customers, Apple, Dell, HP, sorry, we don't have enough capacity to serve you because we're busy over here. Think about it.
Getting permits to build something. I mean, Hamilton County rolled out a moratorium on no data centers, and this is Hamilton County, Tennessee, a real business-friendly state, but they wrote out a moratorium for a year, simply because they don't have the power capacity to handle it if they wanted to. And we are blessed to be in Tennessee with the TVA. Yeah. By the way, I just want to make this point because I'm building this museum, dedicated transportation, and I started to read a lot about TVA. TVA's role, when TVA, which was a part of the New Deal FDR, this region, only 3% of the entire region had electricity. So the government does this massive billion-dollar, hundreds of billions of dollars of capital. Some of it went to Tennessee, some of it went to the TVA. And all of a sudden, they went from 3% of having power because there was no capacity before to having so much capacity that we were able to build Oak Ridge National Labs to build out the original refinement of uranium and to build the aluminum that enabled us to build 300,000 airplanes. The point that I'm making on that is that the amount of power capacity where no one could have imagined in those days that we could supply so much power, it enabled us to win World War II. Had we had not had that big capital expenditures, who knows how World War II would have ended up. And the point that I'm making on that is it's hard for people, if you go back and look at the 1930s when this was first being imagined, there was a lot of public outcry about the fact that these poor people in East Tennessee and Alabama didn't need power. This was overdone. There was too much capital being spent. What ended up happening is it developed this entire region. We ended up using the power. I think the same thing is going to happen in AI data centers. I think the imagination of the economy that we have today, we can't imagine. And had we not done that during the 30s, we would not have been positioned to win World War II in the 40s.
Yeah.
Yeah, I see that very similar to the point I made earlier, Craig, about the early days of the internet, compared to where we are 20, 25, 35 years later, and all the things that we do with it, taking it for granted. I think the exact same thing is going to happen.
Yeah. Okay, so we could talk about this, I feel like, for literally the full 2 hours. There is a lot more to unpack there, but I want to take it back to some transportation logistics stocks. Are there any that you're watching especially closely right now and truly anticipating their releases coming in the next few weeks?
Well, I will say this, that, long time doing this. I think the prior guest said he's been doing it for 40 years. I'm a little younger, only about 30. But I learned a long time ago that we have to watch, freight traffic, both truck and rail, as an indicator for the overall economy. And, if we tie that traffic data along with some of the data points that we get, whether it's from ISM or S&P Global or even the monthly industrial production numbers, it appears that the economy is kind of heating up. I will say to the audience that we are long in the Street Pro portfolio shares of PACCAR. The reason for that is because of the EPA mandate that will kick into gear in the first quarter of 2027. And typically when we see this and the incremental cost for trucks, there tends to be a pull forward in demand. And lo and behold, again, as I'm sure you guys know very well, we have seen a real strengthening in Class 8 heavy truck orders. And I think we're going to see the builds come and translate into incrementally higher margins and earnings in the back half of the year. So I'm really looking for comments to that from, not only PACCAR, but its competitors as well.
Yeah, Chris, well, I've talked to a number of the OEMs. We actually had the Daimler Finance, their truck finance business, as guest, the CEO and the chief revenue officer. And what they're telling us, there isn't a big pre-build. I mean, we finally got the NOx emissions rule from the EPA, but it wasn't, it sort of muted some of that, but they're not seeing a substantial pre-buy happening. There is, I think, new truck orders because fleets are just, they haven't been spending a lot of money due to the freight recession
cycle
and are trying to replace. I think that may be a bigger factor, but it seems like the pre-buy was a story that potentially a year ago we all expected, but really our sources are telling us that there isn't a big catalyst here.
Well, to the extent that, it's the age of the truck fleet, to the extent that the one big beautiful bill gives us, accelerated depreciation, which would be good for buying trucks and maybe a little pre-build, we'll see. I think that's a trifecta that's very positive for heavy truck demand, and that still keeps us bullish on the name.
I would be bullish on truck demand. I mean, just simply take the whole emissions side apart, which I think is better, because the issue you get with a pre-buy at emissions is you get this hangover. So you have this massive surge of demand in what would be a couple month period, and then all of a sudden we end in 27, and you got this more expensive truck, which is estimates are anywhere from $8,000 to $25,000 increase due to the engine reconfiguration. You get a bit of hangover. I think having more sustained replacements, fleets thinking about expansion to grow their fleet is a positive thing. And they're not going to overcorrect because the driver situation is what keeps the industry from overcorrecting. Again, these are natural constraints.
Yeah, no, look, conceptually, I agree with you. I would say that in my 30 years, I've seen these EPA mandates and the pull forward happen. And to your point, if in the past when they've when the phase-in date has happened, we've seen truck orders tumble, but the data will tell us, the extent that there's a structural change unfolding. It sounds like it is, but as a guy who follows and tracks the data, that's what I'm going to want to see.
Yeah, I mean, look, I think we've never seen the great a recession like we've just got out in freight. So that hangover, again, may be the best thing to happen to the manufacturers and the engine companies like Cummins, because they didn't overcorrect. They did not overbuild. I think we're all worried about the overbuild and the overcapacity situation as we look at this freight market. Julie, we finally have things going well. We don't want to lose the party anytime soon, and I hope, Chris, that we don't see that happen. Really appreciate you being with us. Look, earnings season is going to be really interesting. We hope to have you back after we get through earnings season to hear what we learned.
Yeah, thank you.
Great.
So much.
Look forward to it.
Thanks, Christopher. Up next, we're going to talk to Orderful's CEO. Orderful is a provider of EDI, and we'll hear what they're seeing in technology. They just closed a $35 million funding round, and it's all based on the bet that the EDI will be enhanced through AI. We're going to hear all about it.
This segment is brought to you by Descartes. The best supply chains aren't just faster, they're more connected. That's why leading companies rely on Descartes' global logistics network to connect, collaborate, and move freight with greater visibility and confidence. Powered by innovation in AI, Descartes helps businesses deliver smarter, uniting the people and technology that move the world. Learn more at Descartes.com.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara Driving Coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
In today's freight environment, every second of uptime matters. Of course, maintenance is inevitable, but large fleets cannot succeed on reactive fixes alone. That's why Love's Truck Care delivers smarter preventative maintenance. Love's understands that operational pressures demand a nationwide service network for better visibility, actionable intelligence, and consistent execution, all of which you protect your assets, reduce your total cost of ownership, and maximize your uptime. Maintenance is, of course, inevitable, but large fleets cannot succeed on reactive fixes alone. That's why Love's Truck Care delivers smarter preventative maintenance. Learn more.
Welcome back to FreightWaves Today. We have next up Eric Kaiser. He is the CEO and founder of Orderful Technologies. Orderful is trying to disrupt the long-held standard of freight transactions, EDI. Eric, you just closed $35 million with Coke Disruptive Technologies, which is a venture arm of Coke, not the beverage company, but the company, one of the largest privately held companies in America, a lot of commodity businesses. They also own KBX Logistics, which is a very large freight broker. Georgia Pacific is also a part of that business. What was the purpose of the $35 million? What do you hope to do with the funds?
That's right. Craig, thanks for having me. The funds are really here to help us continue to solve EDI problems. So, our whole mission as a company is to turn these EDI onboarding experiences into an experience of flipping a switch. Traditionally, what I was seeing as like a EDI developer is it would take, call it, months to go live with a partner, or even quarters, or sometimes even a year. Over the last 9 years of Orderful, we've been able to turn that into an experience that takes, less than a couple weeks. Recently AI, I just watched the last session about talking about AI and logistics. AI has been a huge tailwind to automate things like services. The last couple of years at Orderful, what we've been working on is how to agentify that whole EDI experience and turn it into something that takes not weeks, but call it days or minutes to go live with a new partner.
So Eric, the conversation last segment was all about whether this bubble is going to burst. I listen to hear you talk. I'd love to hear your thoughts on whether you think, are we in the early phases of AI? Are we near it? What are your thoughts on sort of the AI build out?
Yeah, I think we're in the very early stages of this. What's amazing is how fast it's influencing technology, right? I'm sure every company's trying to figure out how to use it. Engineering teams are no longer writing code. It's kind of amazing that, call it in a 12-month cycle, something that seemed impossible 12 months ago, now everybody's actually writing code. I think if engineers are spending time writing lines of code at this point, like, they're probably not spending their time doing the right things. It's been extremely transformative. I think the early stages of it are all around cost. You're seeing, the Anthropic cost skyrocket, and you're seeing ChatGPT release, a new model recently that's way cheaper and has almost the same power. But yeah, I think we're in the early innings of it. Probably a few more years until the dust settles and we're all kind of using the same sort of open source or LLM models.
Yeah, I mean, I know we were talking about this earlier, is when you go to Claude, things are slower. Like, it takes a while to get an answer, which suggests to me that, like, the revenue's not slowing. I spent the weekend in Miami with Powell. We went to the World Cup. They hosted us as sponsor of the show, and there was a number of large corporate enterprises that were implementing AI in their business and seeing, real successes of these AI implementations and really streamlining a lot of their ops. But it feels so early, because every CEO that was in attendance, these are big companies, we're all talking about how it just feels like we're not as businesses able to move fast enough. Which, as long as you have that, there's so many technologies in this space. Visibility comes to mind, where there's a lot of hype around it. You could argue blockchain is sort of the same thing, where it's a lot of hype, and then people get disenfranchised when it doesn't achieve those goals. I don't hear anyone saying, in terms of that is actually successfully implementing AI, that, hey, we don't have more things that we want to do. It feels very early.
It's very early. I think using it in a really focused problem case like EDI is actually an amazing place to find a lot of use cases for it. The challenge with EDI is how do you start to communicate with other businesses, right? Like, the actual technology of EDI has been around for 40 years. And from a technology standpoint, like, building an integration isn't that complicated. But where things get really tricky is understanding, like, what are the unique kind of requirements of each partner, right? And AI being a great use case for this, you can actually learn, like, who is the person at Macy's that handles the EDI transactions? What do they care about? What do they look for in testing? how do you actually interact with them? And you can automate a lot of the services out of the traditional kind of, services work that's been there. I think, there's a huge opportunity to kind of get a really narrow focus with AI and solve some really big problems.
Yeah, I agree. So we've just talked about EDI has been around for 40 years. Why has no one worked to rebuild it? Why has no one else worked to make it more efficient? And then give us some examples of how you're changing that.
Yeah, great question. It turns out to be a really hard problem to solve. The problem's been around for 40 years, and there are some really big companies out in the market that are providing EDI services. I think what's unique about Orderful is 9 years ago, we took a very different approach to the problem. So instead of solving this with people and building, teams of program or project managers or project teams to go execute customers, what we did is we kind of looked at the problem and flipped it upside down. We thought, how can we build a platform that brings both parties together and automates the entire experience? I think that's kind of the main differentiator here for Orderful is, we completely from the ground up built a self-service software platform. The other reason why the market, hasn't changed is a lot of people are making a lot of money on EDI. The services, the consulting fees, it's kind of keeping the lights on for a lot of large providers, right? And what we're trying to do here at Orderful is completely disrupt that environment and provide an automated experience. And AI has been a massive tailwind for that.
Eric, you Coke Disruptive Investor, you did a process, you ran a process. Why did you choose Coke as a partner?
I mean, they're, like you said, they're the second largest private company in the world. They give us a lot of support, not only with their portfolio companies, but they also happen to own the N4 ERP ecosystem. We're looking to build a solution that solves EDI for all of N4's customers, which is very exciting. And as we continue to grow, Coke could be a partner that would help us, continue to kind of take the market and give us options as we continue to scale.
So KBX, part of Coke, their logistics arm, has reportedly cut their onboarding steps drastically, improved time for onboarding. Can you walk us through that, and then give us some other examples of some of your customers and what they've been able to accomplish?
Yeah, so about 5 years ago, we started working with KBX. Their main kind of EDI challenge was integrating with all their carriers, right? They had hundreds of carriers. The big problem is onboarding all of those carriers and kind of moving those carriers to a new platform. They had several hundred, I think it was north of like 600 different carriers. What we were able to do for them is eliminate this kind of 95-step EDI onboarding process. And those steps really come down to human interaction, right? And human interaction would be like, KBX sends an email to a carrier responds, and there's delays. There's all this kind of gray time or kind of wall clock time where nothing's getting done. With our platform, we're able to kind of, in a multi-tenant way, distribute our software to all the carriers, get those carriers onboarded in a self-service model, and reduce a lot of those steps and reduce a lot of those human interactions that it normally took to go live with a company like KBX. EDI powers the supply chain, right? It's kind of this unspoken dirty problem that everyone has, right? And everybody's just been okay with the status quo. What's been amazing with and working with KBX is they were not okay with that status quo, and they were looking for a better way. They've been an amazing partner through the journey.
So Eric, I always try to meet founders, and I'm always curious what makes them, what drives them. I can argue that EDI is kind of a boring topic. How did you get excited to go?
There's no argument there.
Well, it's like my wife said freight was boring before COVID, but by the way, I was right. She was wrong. Supply chain and freight became super hot. And now people will actually have conversations about cocktail receptions. Are we going to see that with EDI? Why did you decide to go after the EDI problem?
Yeah, I was actually working on the ground as a consultant and building custom media integrations for manufacturers, connecting them to their supply chain. So, building direct connections between, a retail brand and their logistics providers or their retailers, or their warehouses. And what I realized is that, all of the incumbents were kind of over promising and under delivering in the market. I also realized this is a really big market, and that every company that has a supply chain actually has this problem, but it's also very underserved. Um, Turns out that EDI is actually a very hard problem to solve. I'm grateful to be in this space. Um, but yeah, that's kind of how I got into it, and I got obsessed with this idea that we could turn it into something that is an experience like flipping a switch. It didn't have to go through the status quo of taking, call it,
And I think
90
sometimes
days, 120
underestimate
days.
how important. I'm sorry, I lost audio for a second. I didn't mean to interrupt you.
No,
I think
it's
we
okay.
also sometimes underestimate how important it is. Like an
Yeah.
EDI outage was like the end of the world.
I mean, it's a connective tissue for these.
It's how
supply-
everything is, to your point, connected. How you receive tenders, how you invoice, how you get all of those things done. I do have one question as you were talking about KBX and the carrier portion of it. That's always a hard part. Not all carriers, especially smaller carriers, have the team, the resources to do EDI connectivity. Does this help solve that as well?
Certainly. So we provide, we have a web portal where they can actually transact without integrating, right? So they can be compliant same day. And then from our product experience, we make it really easy for them to connect once to us. And once they're connected to our API, they can then access this larger network of connections. We're applying the same model in retail. We're representing, starting to represent some of the largest retailers in the world. We're both the infrastructure and the onboarding service for those retailers. And what's really exciting is that, not only are we making it really easy and fast for those brands to connect and trade with those retailers, but we're also eliminating any sort of chargebacks or disruptions that could be caused by making EDI mistakes. To your point about EDI being the lifeblood, it's really important that, the EDI provider is up, right? If we're down for a day, I don't know the exact number, but a company like KBX could lose out on hundreds of millions of dollars of orders in a day, right? Same goes for a large retailer. So we had to early build a lot of trust with the market that we could be that kind of system of record that enables that kind of business to business trade. But now what we're doing is not only solving for that ease of onboarding problem, but we're also eliminating any costs. So in the case of this large retailer, they're spending about $10 to $20 million a year on receiving errors. And these receiving errors would be like receiving physical goods that don't match the digital document. So if you think about like an EDI transaction, it's actually the digital representation of what's actually being shipped, right? So if we're receiving goods at a dock and that doesn't match what's on the kind of the advanced shipment notice, which is the EDI transaction, then we can't actually scan on that package and receive it. So instead of providing kind of a chargeback reconciliation experience or an experience to kind of audit your invoices with these retailers, we're actually becoming the cure for these supply chain problems. I mean, the same is also true in logistics. Our platform kind of eliminates all of those errors from happening because we're validating that data in the middle.
So on Friday, we had Bart DeMonk when we talked about the Trimble divestiture of their transportation division, which will be a big story once that transacts, which we understand they've hired a banker, according to a report in Axios. Goldman Sachs is the banker that's trying to sell that business for Trimble. We had a debate on Bart contends that he was at Gartner, that the small companies, the more nimble companies, can move faster in an AI world, whereas the large conglomerates or large incumbents, Trimble being one of those, are slower. I would argue, and this is my argument, I'd love to get your take on it, Eric, that actually in an AI world, companies like Trimble have a lot of advantage because they're able to implement faster, quicker, move more nimble than they've ever been able to move. What's your take on it?
Great question. I think the challenge is really kind of like, how do you organize your team to move quickly? Right. I think the advantage of the large company is they have a ton of cash, right? They have a lot of runway, they have customers, they have a lot of kind of problems, a lot of the early stage startup problems are already solved, right? They have this huge kind of ecosystem of partners, customers, and they've got a lot of money. But really what it comes down to in terms of leveraging AI is how do you organize yourself to advance, the problem and base your goals on outcomes, right? So instead of having these traditional kind of product teams that companies used to have, where you may have, one product manager and 5 developers writing code to build a new feature or a solution, right? Now you can organize teams in really nimble and small ways, to get outcomes quicker or more quickly, right? So, one of the things we're doing at Orderful is, we're breaking our product and engineering team up into really small cohorts, and we're all kind of racing towards this shared goal of automated kind of trading partner onboarding, right? So for our entire network, and there's over 10,000 companies on our network, what we're trying to do is build agents to automate that entire experience, right? And the only way we could do that really quickly is to kind of reorganize the team to be a lot more nimble and gear them towards outcomes. And I think, as you look at like larger organizations, there's also, a few public EDI competitors out there. They're going to have a really hard time kind of reorganizing themselves and moving that quickly. I think that's kind of the big hurdle they have to get over is, how do they create the shared vision? How do they kind of measure the outcomes, and how do they organize themselves to go execute against that?
Yeah, it's a really great question. Julie, you and I both worked in big businesses and in small businesses, but do you think the incumbents win? Or do you think it's the disruptors? I actually feel like AI levels the playing field in ways that we haven't seen before.
I think it is fully dependent on
the culture.
So much of what Eric said. Yeah, the culture and how they organize it, right? Like, you can read The Innovator's Dilemma, and if, let's say, they've made it past that and they've already decided what they want to do, right? They've gotten out of their own way and they can be innovative about what they want to do. Then can they get the appropriate resources assigned that aren't pulled into other directions? Can they make these small, one pizza teams or whatever the thing is, and actually make progress on it by just doing versus spending all of their time reporting back to the other teams on what they're doing. And I think that that's what gets really hard in a big company is you're spending so much time communicating internally, letting everyone know what you're doing so that nobody's feelings get hurt and all the political boxes are checked, that you're spending your time doing that and creating, presentations to show your boss what you've done instead of just doing it. Yeah.
Although it is easier to run a bureaucracy when you have AI to help you put reports together, right?
Yes, but still, you're still using time to do it.
You are. I mean, distribution. I don't know. It's going to be interesting to watch, Eric. We'll see where it ends up. The last question I have for you is, how's Grace Sharkey, a former FreightWaves reporter? We wish her well. I do see her out at conferences. How's she doing for you?
She is amazing. She got me here, so super grateful for that. But yeah, she's a shining star.
Well, a friend of the show, a friend of FreightWaves, always once here, and will always be a fan of her career, helping Orderful tell their story with a lot of new money. So I'm going to advocate for her getting a big bump and bonus and salary increase, Eric, because she certainly deserves it. She's one of the best that we have had come through these doors. Really appreciate it, Eric. Appreciate your time today. Founder and CEO of Orderful. Best of luck with lots of new opportunity, new investment. Excited to see where it goes. I am really curious, Julie, on this whole incumbent versus because I just feel like AI enables you to get stuff done faster, particularly when you're talking about the bureaucratic morass that exists in big companies. AI can help you cut through that in some ways because you can just produce those reports. Claude can write the report for you.
Somebody's still reading the report and wasting time doing that instead of just like
instead
of just doing what you know is right.
Gemini or Claude is reading the report. There's a great
and then summarizing it to them. So we're just doing all this internal communication for no reason then. Like
Claude is summarizing it to their Claude, and then all of a sudden, it's how you do it, and you realize it's not that useful. I mean, you're seeing, for better or worse, you're seeing big companies substantially cut these big numbers. And because they're realizing they don't need a lot of that bureaucracy. Now in freight, we'll see, who knows, but I think ultimately having run technology businesses, distribution wins out. I think AI does in many ways create more efficient delivery. So we'll see. Tomorrow we have a treat. We have NFI. Sid Brown is going to be on the show with us. Talk about, as a privately held, one of the largest privately held motor carriers in the country and warehouse operators. He's going to get his take on the market. And then we have Jake Detmer. He's with Optimal Dynamics. Going to hear a lot about what's happening in technology there. So that's tomorrow at noon. We'll be right here.